Hey, what's going on, guys? My name is Saeed. I'm a licensed loan officer, and in this video, I'm going to share with you how to prepare for your purchase of your home. If you're looking to buy a home for the first time and you're not quite sure what the process is or how to start saving for your down payment and closing costs, this video is going to be just for you. So I'm going to talk to you about credit, debt to income, down payment, closing costs, and how to start budgeting for your closing costs and the down payment. So without further ado, let's get into it. Okay, so when you want to buy a house, you're going to have to get yourself pre-approved. And getting pre-approved means that you go to your local bank or you go to a private lender like the one that I work for, and you're going to have to apply. You're going to have to fill out a mortgage application, you as the borrower, and if you have a spouse, they're going to be your co-borrower. If you are looking to buy a house with a friend or a sister or brother, for example, you can have them as the co-borrower as well, and we're going to take them through the same process that we're taking you through. We're going to determine their eligibility. So what we as lenders and loan officers look for once you're getting yourself to, in the process of being pre-approved, we're looking at a few main things that are really important for the closing of your loan. Because what happens is once you apply for a loan and you get yourself pre-approved, we need to make sure that you're gonna be able to pay it back. And that means you're an eligible borrower. So once we give out a loan and you move into your house, that loan actually doesn't even stay with the bank or the local lender that you use. We take that loan and basically hand it off to the secondary market, Fannie and Freddie Mac, that end up packaging those loans up together and trading them on the stock market. So we as loan officers need to make sure that you as borrowers are completely eligible and are able to pay it back. So we're making sure that you basically meet a certain set of criteria that Fannie and Freddie Mac set for us as lenders and banks to approve people. So for example, what we're gonna be doing once you submit a loan application is looking at your credit. So the minimum scores for our company, at least for what we are able to approve people on, is a 600. So having a 600 or higher credit score is going to allow us to look into what's called an FHA loan. It's a government-backed loan. There's some lenders out there that give you the ability to go down to 580. They do require some higher down payment, but 600 is probably where you want to be if you have some money saved for your down payment. 620 is going to give you the ability to, give you some options for down payment assistance. 640 is going to give you some additional options in terms of purchasing power. And then once you start reaching like 740 and higher, that's going to be your best case scenario for the best terms and your eligibility factor. So if you have a 740 and you have some down payment, and you're basically just an overall good person at paying back the debt that you incur, we're gonna be able to get you access to better interest rates, and that means a cheaper payment every single month. So credit above 600, at least for our company, is probably where you wanna be. I would say just in general, have at least a 600 before you go apply for a loan, because that's just gonna give you the ability to actually get a loan in the first place. 580, like I said, some lenders will give you that option to get into a loan product, but the terms just aren't gonna be as favorable. So the next thing that we look for is your debt to income ratio. So a debt to income ratio is essentially created by looking at all of your debts showing up on your credit report and then adding those to your proposed monthly mortgage payment. The mortgage payment itself is going to be determined by the interest rate and the insurance and taxes. So we create a mortgage payment by simply putting in a loan amount, figuring out what the interest rate could be for you, and that's going to be your principal and interest payment. Then you have to have insurance. We calculate that on top of it. Then we have your taxes. So every house is going to be required to pay taxes. So your principal and interest, taxes, and insurance, those are all calculated together along with your payments that you're paying out every single month that's showing on your credit report. That divided by your base monthly income, that's gonna be your debt to income ratio. So we want to make sure as lenders that your debt to income ratio is below 45%. If we have the ability to go with a higher debt to income ratio up to 50%, we're going to give you some of those options. But having below 45% and having credit above, I would say 640 or higher, it's gonna give you some good chances of getting into a better loan product that's gonna give you the most bang for your buck, meaning the least amount of payment every single month that you're gonna be paying for your mortgage. So the debt to income ratio is what we're looking at. We can omit certain things from the debt to income ratio, things like installment payments. So if you have installment payments less than 10 months, then we can take those out of your debt to income ratio. So let's say you have a car payment that has only 8 payments left on it. We don't even need to calculate that into your debt to income ratio. Or medical bills. If medical bills are showing up as payments on your credit report, we don't need to take those into account. Same thing with student loans. We can basically just take a percentage of your full balance if the payment on your credit report is showing 0. So there are some ways to really kind of work the numbers to figure out what's gonna be the best case scenario to get that debt to income ratio low. So if we need to pay some debt off before we can get you approved, we're gonna tell you. If we need to add a co-borrower or co-signer to get your income, to get that income available, so your debt to income ratio comes down, we're gonna ask you to find a co-borrower, co-signer if your income doesn't support the loan amount that you're trying to get. So that's debt to income ratio in a nutshell. The next thing that we're looking at is your income. So the type of income that you're making is important. If you're a W-2 employee, you make a paycheck every single month or every week, and you get paid W-2s, meaning you get W-2s every single year, that means you're a W-2 employee and we can use that type of income. However, we do need a 2-year work history completely. We need a 2-year history from when you started working. So if you have 4 jobs in the past 2 years, that's fine. At least you have 2 years of history. We can go off that as a lender. If, for example, you just got out of school and you're 1 month into school or 1 month into the job, we can use your school tax transcripts, and we can basically just take the transcripts, add them to your current work history, and we can just say, hey, you've been in school, that's the 2 years. Now we're gonna go off of the income that you're making today because you haven't had the chance to work 2 years. So we can do that as a lender as well. If you switch over from a W-2 type income source, so let's say you're getting paid hourly or salary, W-2, and then you make the switch to, let's say, commission, you're gonna have to have at least a 2-year history of commission before we can actually use that type of income. So you wanna make sure that you are working at least 2 years before you buy a house, and if you're planning on making a switch from hourly or salary to commission, make sure you buy your house before you switch over to commission, and don't do it during the loan process because that's just gonna take you right out of qualification altogether. If you own a business, the same thing applies. So if you have a small business, let's say you're doing Uber or Lyft, or you actually have a storefront or a corporation, whatever it is, we need a 2-year history and we need tax returns to actually prove that you're making that income for the last 2 years. And you wanna make sure that you're keeping your write-offs low, because if you write off too much, you don't show too much net income at the end of it, we're not gonna be able to approve you for much because the income that we're actually able to go off of is gonna be super small, and you're just gonna be very disappointed because you're gonna think you make a lot, but you write off so much, and at the end of it, you have so much net profit, we're not gonna be able to use everything that you actually made gross at your business. So make sure if you own a business, don't write so much off before you buy a house. Keep your expenses low and don't write off so much, okay? And the next thing that I want to talk about around income is, let's see, 2-year history, W-2. Oh, so we need documentation for your W-2. So make sure you send in your W-2s if you're gonna be applying and you have a W-2 work history. Tax returns, like I said, if you have self-employment, you got to send in your tax returns. If you've had your business for 5 years plus, we can sometimes go off of the last year or the most recent year for qualification. So that helps if you didn't show a whole lot of income, for example, a couple years ago, but you show a lot of income this last year, we may be able to go off of the higher income that you showed the last year because you've owned your business 5+ years. So that's income and work history in a nutshell. The next thing that I want to talk about is down payment. So there are programs out there like USDA, VA that allow you to get into a home paying 0 down payment. Those are, very rare, or those are for rare circumstances. USDA is for rural community areas where homes are located. There's actually a website that we have to see if the home actually qualifies. VA, obviously, we can get you into a VA home loan paying 0% down if you're a veteran. But if you're going to go with an FHA loan or a conventional loan, FHA is government-backed. Conventional is typically what first-time home buyers go for because they are the best terms and they're the least expensive overall in terms of the term of the mortgage. You are going to need at least 3% down payment for a conventional loan. If you want to get into an FHA loan, the minimum down payment is 3.5%. So 3.5% FHA, 3% conventional. We can get 3% conventional only if you meet certain criteria. So just want to put that caveat out there. If you're going to go with the conventional loan, those are 5% down payment minimum. So you want to make sure that you're saving at least 5% for a conventional loan. If you know you have good credit and you think you're going to be able to get yourself into a conventional loan, 5% is what you're going to want to save. And then anything more than that, you're basically just going to keep the purchase price, or you're going to keep the loan amount lower. So you're going to have more equity into your home if you put anything more than what's required. The best case scenario is if you have that 20% down. 20% down, what that does, it eliminates the mortgage insurance. So I talked about mortgage insurance earlier. Basically, if you put 20% down, we don't have to add on mortgage insurance to the payment every single month, and that's going to reduce your monthly payment, your monthly mortgage payment by whatever that mortgage insurance actually is. So mortgage insurance protects the lender, doesn't do anything for you. It's just an added payment that we have to tack on to protect the lender and protect the bank. So if anything was to happen to your job, or you were to start defaulting, that's why we have that mortgage insurance on there in case you were to start defaulting. So highly recommend speak with the lender or your loan officer and just figure out kind of what's going to make the most sense for your situation. What can you actually qualify for, and what will you need for a down payment? They're going to tell you right away if you can go with a 3% down payment, or you need 5% down payment, or if you get into an FHA loan, obviously, like I said, you're going to have that 3.5%. Some cool things though about FHA loans and conventional loans. If you don't have the down payment right off the bat, there are down payment assistance programs that will actually cover the down payment and some of the closing costs depending on the loan program. So you're gonna wanna speak with your lender and figure out if one of those programs makes sense for you. Okay, so the last thing that I wanna talk about is the closing costs. I'm gonna talk about closing costs, and then I'm gonna talk about the budgeting part of it. And the budgeting part of it is basically how to save for the closing costs and down payment. So closing costs, those are costs that are associated with any type of mortgage. Every lender is gonna have a lender fee, and then you're gonna have to pay all the third-party fees. So title and escrow, you're gonna have to pay certifications. Let's say you bought a mobile home, you're gonna have to buy a foundation certification, pest control. You're gonna have to pay basically just a lot of different fees that come along with a mortgage, and you're gonna be liable for those. Those are coming out of pocket. They can't be built into the loan. So you're gonna just see those on the final mortgage statement once your lender or loan officer tells you, hey, this is what you're approved for, but this is how much you're actually gonna need. That's what they're talking about, the closing costs. So all the third-party fees, and then all the prepaid items. So the prepaid items, those are things like your taxes and your insurance. The taxes and insurance are due on every home, and we as lenders legally have to collect taxes and insurance up front to pad or to basically fund your escrow account. An escrow account is a glorified savings account. So we open up escrow, and when you close on a mortgage, we collect all of those closing costs, or I guess all those prepaid items, put them into your escrow account, and when taxes and insurance are due, that's where the money actually comes from. So when I explain it to borrowers, I say, hey, your closing costs are gonna be X, and they're comprised of our lender fee, third-party fees, and then your prepaid items. So all of that is what you're gonna need, like I said, to come to the table with. So as a lender, we are gonna, give you the best case scenario and share with you, how low we can go based on your scenario, and we're gonna share some options. So for example, if you have, let's say $10,000 in closing costs, we're gonna say, hey, you can get your closing costs covered by the seller. That's one option. They can, literally pay your closing costs. They're just gonna take less money at the end of the transaction. You can get your closing costs covered by a gift. You have the opportunity to get a gift from your mom or dad, brother or sister. A relative is gonna have to give you that gift to cover those closing costs. Or you're just gonna have to pay for them out of pocket. So on top of the down payment, you're gonna have to have those closing costs. So just be aware, closing costs are gonna be separate from your down payment, and that's what you're gonna have to prepare for once you buy a house. So here in Seattle, we have very high purchase prices. We have like 500,000 median home prices, I believe. So for a $500,000 house, you're gonna see closing costs be around probably 11 grand. And that's, like I said, the closing costs of your prepaid items and your third-party fees on top of the down payment. If you go a little bit lower, let's say like $200,000-300,000, closing costs are roughly gonna be like $5,000 to $7,000. And you are gonna have to ask your lender exactly what those closing costs are. I can't give you a great specific number, but anywhere from $5,000 to $11,000 of closing costs if you're buying anything from $200,000 up to a $500,000 home. So those are the main things that go into the loan application and what we're gonna be explaining to you and talking to you about. The next thing that I wanna share with you is gonna be how to start saving. So up here, there is a video that I did on how to budget, and in this video I talk about how to actually track your expenses, how to save for a rainy day fund, and how to actually calculate your variable expenses and variable income. These are all super important that you need to do to be able to budget. So a budget is just a tracking system that allows you to track all of your expenses and all of your income, and it shows you on a month-to-month basis what you're saving and where you're gonna be in 3, 6, and 12 months. I break it all down in that video that I'm gonna have up here. So I highly recommend that you actually just start doing a budget, track your expenses, and do it for the rest of your life. This is something that's changed my life, and it's something that I always recommend to anybody who wants to start saving for anything. Tracking your expenses, budgeting your money, getting control of your finances is huge. So I'm not gonna go through it myself right now in this video. I'm gonna go through it myself in this video up there. So I highly recommend, check it out. If you guys found some value in this video, give me a thumbs up. Subscribe if you like this type of content. I know it's kind of guerrilla style. I'm just coming at you with info. And yeah, guys, let me know what questions you have in the comments down below. I look forward to answering some questions if you have them, and let me know what you think. So appreciate you guys. See you on the next one. Take care.